Good afternoon, everyone, and welcome to the Robertson Stephens Investing in ESG webinar. My name is Raj Bhattacharyya, and I'm the CEO of Robertson Stephens. 2020 has been an impressive year for environmental, social, and corporate governance, otherwise known as ESG investing. Some of the renewed energy in the space can be attributed to the turbulence of the past year and a focus on the key issues at hand. 15 years ago, ESG would have been a foreign concept to most investors. Today, ESG strategies are a ubiquitous presence in the investment landscape, with nearly $50 billion of new inflows coming in each month by the end of last year. Our speakers today are Chief Investment Officer Stuart Katz and Head of ESG and Impact Investing, Christopher Knapp. They will be sharing our firm's philosophy and investment approach to ESG, as well as trends that we are seeing in the market. They will also share a vision of where ESG came from, as well as where it's going, as it becomes ever-present factor in most portfolios. This webinar will be recorded and posted on the Robertson Stephens website by the end of the month. The material we will discuss here today is intended for general information purposes only and should not be construed as investment, tax, or legal advice. The contents of this webinar may not be quoted, recorded, copied, reproduced, or redistributed in any form without the express written consent of Robertson Stephens. I will be moderating the panel discussion and encourage everyone to submit your questions throughout the session using the Q&A functionality found at the bottom of the Zoom screens. We will be collecting them and try to answer as many of them as we can within the hour. With that, let me start with Chris. Welcome, Chris. You've been in the industry and focused on ESG for over 30 years. Could you provide us with a brief overview of the trajectory and history of what is now referred to as ESG?
Of course, yeah. Thank you, Raj, and welcome everybody. Well, these are not new ideas, I guess is the first I would say. And what started out a couple decades ago is what people often call socially responsible investing, was often came from faith-based organizations who were frequently going to their investment advisors and holding up their mission statement in one hand and their investment portfolio in the other. And if you look back in the late 70s and early 80s, there was a complete misalignment between the mission statement of these organizations and the portfolio holdings. Examples might be munitions companies, defense contractors, tobacco, gaming stocks. And in an effort to align the mission statement and the investment portfolios, many investment firms were effectively restricted from whole industries and individual names. The cruel joke, as I call it, is that by trying to do the right thing, the performance often suffered immeasurably for several years. Tobacco, for example, the industry was one of the best performing industries for about a decade. So for trying to do the right thing, the performance of these portfolios by trying to be mission aligned often suffered. A great deal has changed. They called that process a negative screen, where you were effectively tying the hands behind the back of your portfolio manager. Don't buy me this, don't buy me that. Today, advanced largely through technology, like what we see in a smartphone and transparency and data aggregation, we have access to all sorts of information around what's called a positive screen. So importantly, as we think about ESG at RS, we're not abandoning time-tested principles of fundamental securities analysis, critical thought, and primary research, but we're also applying ESG principles on a positive screen. So to think about how do these companies stack up against, say, environmental stewardship, labor practices, what's called parity, which is the promotion of women and people of color to corporate leadership, supply chain integrity, et cetera. So the great news is what was once dismissed as folly and not being competitive with market return has changed quite dramatically in, frankly, just the last decade.
Thank you, Chris. Today, we've seen billions of dollars entering the market in various forms of ESG investing. We even see the CFA Institute launch a certificate in ESG investing. Would you now consider ESG to be mainstream?
In many ways, yes, although I'd say it's still largely misunderstood. I think it's really easy for people to look at ESG and not really understand what it is. And so here we take a look at, we've got a couple of slides here, just looking at the magnitude of the shift here towards your question on mainstream. The UN has signed on with the Sustainable Development Goals, a slide from which we'll see in just a moment, but we have now over 3,000 signatories of the principles of responsible investment. What's astonishing is that represents 90 trillion in assets globally, so an enormous sum of capital. Now, to be clear, just because these entities have signed on to the principles of responsible investment does not mean those underlying assets are invested in ESG, but it's a major shift towards recognizing that these are real issues and that they're highly investable. Patty, if you'll move to the next slide, please. These are the UN Sustainable Development Goals, of which there are 17. Over the course of the last 14 years or so, our team has been working specifically on how to find investments in 9 of these 17. And what's each year, what we see is that each one of these categories, and you can see no poverty, zero hunger, good health and well-being, life on Earth, life under the oceans. This ties to everything. It ties to pollution, it ties to climate, ties to plastics, it ties to toxicity. What we see is that increasingly each one of these areas is investable. I'll also say that within the client base, we see at Robertson Stephens, since we manage assets for a number of families, often multi-generational, is that it's often the younger family members who are bringing this conversation to bear at the dinner table or in the investment meeting. And what we're seeing here frequently is that research loves to study why wealth dissipates. For example, why a family becomes wealthy and then the wealth dissipates over the next couple of generations. There are lots of different reasons for that. One is that people make bad investments, they choose poor managers. But what's really interesting is that an overarching informant of wealth preservation is the ability to embrace a cohesive investment philosophy across multiple generations. And increasingly what we see is tension developing between senior generation mindsets and younger generation demands. And so one of the beautiful things that's been happening with ESG and what I call intensely for-profit mandates, this is market or better return to be clear, predicated on ESG principles, is it's actually now possible to bring multiple generations of any one family around the table and actually share a common investment philosophy with not violating the principles of the senior generation is often valued, which are time-tested, fundamental securities analysis, balance sheet integrity, market dominance in any respective industry. These things are now actually colliding into a truly investable portfolio.
Yeah, that's very interesting, Chris. Stuart, pivoting to you. Chris just laid out that there is a broad spectrum of investment approaches that we can choose from. With so many options, can you tell us more about the Robertson Stephens investment process to address clients who want to have their portfolios expressed, their values? What ESG metrics are important for us in constructing a portfolio?
Sure, and welcome everyone, and thank you for your time. In regards to constructing portfolios, our mission really is focused on protecting and growing capital, and we're investing for the long run. And this conversation about ESG is to make sure that the capital that is in the portfolio for the long run actually has a place to be invested and spent 25, 30 years from now in a world that we can all celebrate and be proud of. And our way of trying to incorporate thematic and what we think are durable trends into the portfolio as it relates to ESG takes a variety of different forms. And we have a page in this presentation, I think it's page 6, which basically tries to communicate and share how we go about this. First and foremost, ESG principles are woven within the fabric of fundamental investing. We don't see it separate, siloed in its own swim lane. And what you should understand from our perspective is that ESG is consistent with quality. It's strong business models, strong balance sheets, strong management teams. And we provide a spectrum of solutions to help integrate the goals of performance and purpose. And if you move along the spectrum here of this page, left to right, what it really is a conversation about divestment on the left-hand side to what I describe as encouragement on the right-hand side. And we have on the left-hand side of this page exclusions, which is the most basic approach that Chris outlined and leans on some current technology that we have in regards to direct indexing, where clients essentially can own title of their own underlying names, say a benchmark like the S&P 500. You can exclude guns, tobacco, gaming, etc. There may be some tracking error relative to the benchmark. I don't mention that either as good or bad, but in terms of expectation management, it may perform different than that S&P 500 benchmark as you tailor and customize it to your values. If you scan your eye to the right-hand side of the page, you see an approach that we describe as impact investing. People want objective metrics to measure the impact of their investment. And a good example of this may be within the arena of green bonds. Just in the last 12 months, there's been several $100 billion of green bond issuance. And for example, a Brazilian paper and pulp firm called Suzano issued about $1.25 billion a few months ago. The bonds were structured in a way that the coupon would go up 25 basis points in cost in the event that they are unable to hit their target of reducing their carbon intensity by 10% in comparison 5 years from now versus a baseline of about 5 years ago. And so we incorporate both active and passive solutions in order to give our clients both performance and purpose in their portfolios, and we can tailor it across this spectrum based on what their needs are.
Thank you, Stuart. Staying with you, as with any type of investing, there are always challenges. In your opinion, what are the challenges of this approach of ESG to ESG investing?
So, look, investing is hard, and we within the investment office approach it with a tremendous amount of humility. We consider ESG factors essentially equivalent to risk factors. And as everyone knows, what is measured can be managed, but can you measure it? And so one of the biggest challenges facing sustainable investing today is consistent disclosure and measurement of these key risk factors, ESG in particular. The good news is that with the new SEC chair, Gary Gensler, he has indicated that he wants consistent and transparent disclosures on ESG matters. And this is going to be a priority during his tenure. So in short, we endeavor to incorporate these ESG factors. We lean on certain third-party services and technologies and are doing our own primary research to weave those in and complement the fundamental factors that we've always been using for years. And we look for companies that understand these ESG risks and opportunities, because there's a lot of research out there that has indicated companies that focus on these ESG risks, what I'll call maybe non-traditional types of risks, are better positioned to protect capital and to address new regulations or evolving customer preferences or even catastrophic events like a pandemic. And so we're going to lean on that history and make sure that we also incorporate and integrate ESG into our process.
Thanks, Stuart. Moving to you, Chris, again, let's talk a little bit about performance. This has always been, and you alluded to this earlier, it's been a big topic around ESG, particularly back in the day when it first started. How do you feel the performance debate has evolved, and where do you think it's likely to go?
Well, a huge shift really in the last decade, where you can statistically show that portfolios that embrace ESG or are invested predicated on ESG principles are statistically outperforming both traditional benchmarks and their peers. And there's a lot of different reasons for this. Stuart touched on a couple of them just a few moments ago, but it's important to recognize how much technology has played into the success of many, or perhaps enabling many ESG-oriented enterprises. Technology has obviously been the old adage, smarter, faster, cheaper, but investing in technology historically over decades has proven to be a great winner. I think the big shift in ESG now, recognizing that technology and has driven returns above benchmark, is that we're starting to see an expanded appetite and sort of adoption, if you will, of ESG principles across multiple enterprises that may not be technology born. So I would tell you that the old adage that by trying to do right meant that you were making a concessionary ask of your client has effectively gone away, and you can statistically show that. I think the big question is where it goes from here. My personal view is that what we now call ESG investing and just good investing will not be differentiated in 5 or 10 years for a lot of different reasons related to what we're living in today's world, both with COVID and climate and other serious issues. These issues matter, and they're basically governance issues. And historically, as you know, the best performers in terms of asset managers have often been those who prioritize governance as the key. And with RS, of course, our bias has always been towards quality, and governance matters. And the E and the S fall very neatly under the G. and always have. We're just seeing greater transparency now about what those issues actually translate into in terms of performance and portfolio construction.
Thank you, Chris. I'm going to pivot to a more macro level in a minute, but before I do that, I just wanted to remind everyone you can submit your questions via the Q&A functionality at the bottom of your Zoom screen. We encourage people to ask questions. We will leave time for questions, ample time for questions at the end. Chris, something that's on a lot of people's minds, given current events, what do you anticipate from the Biden administration on this topic? How will it impact ESG investing?
Well, I think the infrastructure and proposed infrastructure bill is huge. It's important to remember, though, that yes, there's a lot of headlines about the Biden administration, but infrastructure has been talked about in previous administrations as well. What you see across the board is that technology and understanding of science is now allowing for a completely different type of infrastructure build. For example, permeable surfaces are increasingly important across multiple metropolitan areas, just given the nature of flooding. So what you see here, this is a slide that just talks about different categories of investment across infrastructure that includes not only what I call city building, but also food production. So you've got agriculture, you've got clean tech and efficiency. Efficient transport is huge. Low carbon commerce, clean water. Water is probably going to be the most significant crisis of our lifetimes for a lot of different reasons. Renewable energy, power technology, environmental finance, which is actually just how do we think about financing these different really multi-billion dollar, if not trillion-dollar happenings across our economy. If we go to the next slide, what's really interesting, we talk a lot about the US, but if we step back and take a look at the world, what we see here is a slide called The World at Night. And you can see that the top half, if you will, of the picture, which is the Northern Hemisphere largely is illuminated. Whereas the Southern Hemisphere largely is not. It's simply a proxy to say how much work remains to be done in some of the fastest growing areas of the world and emerging markets. And it's important to remember that these countries will not see landlines, and that the infrastructure in these countries will look radically different from what we think of as even in our advanced cities of the United States. So many of the companies that produce the technologies and the products that will be incorporated into infrastructure build, not only in the US, but outside the US, are US based. So investing in these is effectively a call option on where the growth is going forward.
And Raj, if I could just expand on that, just in regards to two other key areas that are important to the Biden conversation around this: taxes and permits. Solar and wind are very price competitive today without much support, but are likely to receive more tax credit support as part of this infrastructure package. Beyond that, cash refundability of tax credits is on the table, where renewable developers generate tax losses when they build projects. The challenge is, how do you effectively monetize those tax losses? And the short answer is, today it's difficult, possible, but difficult. Can you make it easier? According to the infrastructure package, they may turn these credits into actual refunds, literally checks from the government that would boost the liquidity for these renewable players. The second dimension around permitting, especially a conversation around the East Coast, where there have been lots of discussions of offshore wind. There's a shallow shoreline on the Atlantic off the coast versus the Pacific. So it's a more relevant discussion on the East Coast. And the thought is, well, how do you permit that? And then how do you also permit the transmission lines that then ultimately have to be brought on shore? And the idea is not only to facilitate, if you would, wind power, but to facilitate the implementation through easier permitting. So those are other kinds of considerations as part of this package.
Thank you, Stuart. Speaking of climate change, no coincidence for the timing of this webinar. It is Earth Day tomorrow, and there's been a lot of talk about climate, sticking to one of the pillars of ESG. BlackRock, for example, recently stated that the company is committed to doing its part to help transition to a net zero economy. Stuart, can you elaborate on what we mean by net zero, and what are the opportunities and risks in this low carbon transition?
Yeah, absolutely. So fighting climate change is about making the planet get less hot, period. You know, the more quickly countries slow down their carbon emissions, the faster that will happen. And we have a page, I think it's page 8 in the deck, that outlines what promises some countries are making. And all the more important for the nations that pollute the most, but not all of them are on board with this. You know, a majority are, including China and US, which are 2 of the largest polluters in the world. And they're setting future targets to go to net zero. However, other important countries like India doesn't want to commit yet to when to stop burning fossil fuels because they're concerned about their own economic growth. So net audience, the net zero refers to achieving an overall balance between emissions being produced and emissions being taken out of the atmosphere. You know, think of it like a bath. When the tap is on, an approach to achieving this balance, you can either turn off the tap, that is turn off the emissions, or drain an equal amount of emissions out of the tub. And the question is, if you're going to drain it out, where do you store it? And there are technologies in and around carbon sequestration and other kinds of innovative ideas that could potentially be attractive risk-adjusted investments. In regards to this risk of decarbonization transition and some of those challenges, a lot of research is suggesting that we will continue to see increasing oil demand, which will peak sometime around 2030. And there are 2 key drivers of oil demand, and then there are sort of 2 key drivers in terms of weakening that demand. 2 key drivers of increasing the demand: population growth and rising average wealth. Those 2 things tend to sort of put their weight behind, in the medium term, short to medium term, demand for oil. On the other hand, oil demand goes down with efficiency gains. People probably are well aware that an average new car sold today is 2 times more fuel efficient than the average car on the road. And then there's substitution, right? You know, you've got traditional old school cars with electric vehicles. And so with roughly 1 billion people, the world population is growing by 1 billion people every 15 years. And with people becoming wealthier, that's going to continue to put some pressure and create some challenges in terms of this fossil fuel transition.
Thank you, Stuart. Last question I will pose to both of you before I start going through the audience questions. What are some of the other trends you're seeing in the space?
You know, I'm happy to jump in. You know, there are people know that as a result of the reopening of the economy, it's a K recovery, right? In essence, meaning not everyone is benefiting equally, and some are disproportionately benefiting, and some are disproportionately being harmed or not participating. And so innovation in and around healthcare, providing easier access to healthcare and lower cost access to healthcare are some developments that are taking place that will help in regards to the social aspect of the ESG. And so participating in healthcare innovation, again, can provide both purpose and performance. The same holds true with education and electrification. You know, China has roughly 500,000 electric buses as part of their public transportation system. The United States has maybe 1,000. 500,000 to 1,000. China's been investing in electrification now for a while, and they're ahead of us. And so those are some interesting trends that are going on. The other key trend I'd focus on is storage. So we're talking about generating electricity through renewables, solar, wind as example, but we know that there's variability. The sun doesn't always shine, the wind doesn't always blow. So how can you store that? Well, that's batteries, but sometimes every action has an equal and opposite reaction, and you need sometimes rare earths and certain kinds of metals like lithium, which are then mined, and then are they mined in countries that take advantage of people, and are they appropriately compensated, or do they have proper safety measures in place? So it's, in short, the ESG, it's complex, but those are some of the trends that we're seeing.
And I would add, Raj, to Stuart's comments, growing awareness of toxicity on the planet. Pollution is now the number one killer on the planet. And so how this translates into investable themes would be investing in consumer products that are non-toxic, for example. And in a relatively easy household example is 7th Generation, which is a detergent, as many of you know, that doesn't have chemicals in it. It was dismissed largely at the launch as, to your earlier question, is, oh, this is a little bit of a folly. It's the domain of the wealthy. This isn't really practical. This is a business that was sold a few years ago to Unilever, one of the world's largest, if not the world's largest consumer products company, for about $700 million. You can now buy 7th Generation products on the shelf next to Tide at CVS. So you're seeing a massive adoption of consumer products that reflect the fact that there is growing awareness of toxicity. Water, as I mentioned, the lack of access to clean water, the number of people on the planet without access to daily clean water is astonishing and also highly investable. So major theses here around toxicity, pollution, and awareness of cleaner living.
No, thank you both for that. At the end of the day, we have to invest in themes. Audience question I'll give to you, Stuart. How did the 2020 pandemic impact investor focus on ESG investing and demand?
In short, it's raised awareness, and people have heard this phrase many times before, but it's relevant and true, so I'm going to mention it. It pulled forward interest and demand. And in fact, an important part about investing is curiosity and asking questions. And it's really enjoyable to interact with our clients because there's a lot of curiosity. And we get to benefit from that in engaging in the exploration of how do we construct their portfolios in a way that is reflective of some of their questions and some of their needs. And again, as Chris was outlining before, maybe not the current generation, but the next generation. And so a key leg, there are 3 legs to our stool when we construct portfolios. We've talked about capital preservation, long-term growth, and thematic trends. And those trends we think are more durable than a given market or economic cycle. And these kinds of ESG solutions and trends that we're seeing can now be effectively incorporated into portfolios, and people are engaging in that conversation. I think while it may be increasingly more mainstream to have these conversations, I think we're still in the early days in regards to actual implementation, but the questions are happening with greater frequency.
Stuart, can I ask you to elaborate on that a little bit? When you talk about portfolio construction, how do you use ESG factors in constructing portfolios and making investment decisions? What?
Yeah, no, absolutely. So there are some very interesting and robust third-party data services which go out and try to aggregate and then normalize so that you can measure across asset managers and underneath the hood, the actual companies that are reporting in a public forum. And so we take advantage of that data, incorporate into our normal sort of analytic process where we look at what the quality of the balance sheets are, what the percentage of recurring revenues are, what the strength in terms of the balance sheet is in regards to leverage, free cash flow conversion, the moat in terms of the competitive of the business model. And then we say to ourselves, okay, again, we had a page in the earlier presentation where we listed 35 different sub-themes within the E, S, and G. And those, again, are risk factors. And people who are ignoring, to Chris's earlier point, toxicity and whether or not the manufacturing of their good creates some bad environmental outcome, or in the way that they produce their service creates a bad social environment in regards to how they treat their employees, et cetera, et cetera. We think these are actually leading indicators of, more likely than not, weaker profits, or maybe a recurring kind of liability that will have to be paid for that you don't apparently see on the balance sheet. And so we take the data from these third-party resources, we measure the asset managers that we are evaluating, and incorporate that into our conversations when we apply our subjective judgment in interviewing asset managers. We do it on the alternative side as well, because the best way to get a thematic exposure is not only through public, but through private drawdown funds. And so we're in very active discussions with a number of private equity and private credit funds, which have a proven ESG philosophy and process.
Thanks, Stuart. There's a question here on greenwashing, maybe because it was in the news earlier today with one of the big hedge fund managers in London, Chris Hone, railing on about it. Chris, do you want to take a crack at explaining what that is and if that's a concern? And how do you ensure, how does one ensure that companies are actually doing what they say and what they're not going to, they're going to do, they do what they're going to say they're going to do?
Yeah, great question. Well, I guess I would say that when just about anything gets big, there's often a lot of garbage that comes in with the good stuff. So to Stuart's earlier point about quality and sort of fundamental research, it's really important to take a hard look at not only the claims being made, but what's the actual deliverable. In many instances, what you see is either asset management or products or funds that are claiming to be ESG specific, but they have no way to actually quantify or measure how they're actually responding to traditional ESG metrics, or for that matter, the sustainable development goals that we just touched upon. I would say it's also, it's harder to hide for lots of different reasons. I've witnessed the stories, the ongoing stories that keep coming out through processing capability and transparency and all sorts of different types of things, for better or worse. News comes out and people are sort of called to the carpet, so to speak, in terms of what their claims are versus what's actually going on. I think it's important to recognize that we've started in this intentionally pragmatically. You can find a wart on every company that you want to. You can find something not to like. We're still in very early stages of ESG integration, or impact integration, if you will, in terms of company missions. And so I think it's important to really think critically about what you're looking at. There are many companies that are making massive shifts in terms of both their internal cultures as well as their supply chain. And in my opinion, they should be rewarded, and we should be looking at those very thoughtfully. We're not there yet. And what's important for us always has been to actually take action. If you become too purist, you often get paralyzed and you do nothing. And given the severity and the magnitude of the issues we're seeing in the world today, social equity, climate, COVID are just a few examples that we've seen come to light very dramatically over the last 12 to 18 months. We think it's imperative to take action and reward the better actors. And what we see here is that there's this confluence of both a commitment to measurable data and statistics and metrics with real deliverables. And lastly, I'll say that I think we should really be looking at what the outputs are of the companies in which we're investing. What we see now is products and solutions that are making a real difference. It could be in the type of packaging, for example, that's being used for products that are being sold every day. It could be in terms of the integrity of the supply chain. It could be in what makes a company more efficient in terms of energy efficiency or technology. How to operate a building more cheaply or more inexpensively if you're a property owner. All of these fit very neatly into highly investable themes that are really at the core based on not only good sense and governance, but capital efficiency. And I think it's really important to be thinking in those ways as well.
Thank you, Chris. I'll stick with you for the next question, which is, how do you assist ESG sensitive clients in identifying their values and sensitivities?
It's a great question. There's no easy answer. It's not the same answer for every family or individual, obviously, but historically, it's really been an ongoing conversation. Human nature is such that we don't often respond to things until we're touched tangibly by it. So using climate as an example, of course, we're based in Houston. When Harvey happened a couple of years ago, the statistic that came out was that if that amount of rainfall, they thought it might be 1 trillion gallons of water, had fallen on Manhattan. Houston's very spread out, had fallen on Manhattan, that the depth of the water would reach as high as the top of the Empire State Building. It's an astonishing number when you think about rainfall. When I talk about being touched tangibly, so for example, somebody may not think that much about climate or investing in climate or think it's a priority until there's 4 feet of water in their living room. Somebody might not be thinking that much about climate until not only their house burns down, but their whole city burns down, or whole town burns down. So without getting too sort of dramatic about that, what we see frequently is that within families, and I touched on this earlier, multi-generational families, often things are happening within that family that are being touched by something. It could be social equity, it could be climate, it could be pollution, toxicity. It could be an awareness that health is not what it should be, given the exposure we have to toxicities. So these become very personal. Then, our job is actually to translate what that mission is, if you will, or what that particular interest is, into a highly investable portfolio. The great news is that it's intensely doable. And personally, I believe it's, for a lot of different reasons, it's really the future of Western style capitalism, because it prioritizes a more holistic view of how we think about priority without actually saying you can't do as well or better than everybody else out there by doing it this way.
Yeah, thank you, Chris. Actually, the next question is somewhat related, and I'll pass it to you, Stuart, which is, how long does it take to transition an existing portfolio over to an ESG portfolio? And when you start these adjustments, what are the main considerations that you take into account?
Absolutely. So when we start thinking about transitioning a portfolio, there are certain key elements that exist regardless as to whether there's an ESG component to it. And those starting questions are taxes and time horizon initially. So to what extent are there large embedded gains that exist in that portfolio? And over what period of time would you be willing to sort of invest, if you would, or pay some level of taxes in order to make that transition? And one of our philosophies in and around transitions is to say that it's important to be tax aware, not tax afraid, and to be aware that by staying in your existing holdings, whether there's an opportunity cost in terms of purpose and values, or an opportunity cost just exclusively focused on performance, you may be in a fund or in a set of securities that really aren't giving you the kind of risk-adjusted return that we think maybe you can do better. And so can we go from good to great? And we think about taxes and time horizon in that regard. Specific in terms of the ESG, that's a very personal decision in regards to exactly how strictly you want to adhere to certain values. And we would have that conversation in partnership with the clients to learn and tease out, again, the key sensitivities. And some sensitivities may exist in and around fossil fuels. Within the industry, there are some very large multinational oil companies that basically are saying, I'm just going to focus on what I know and continue to extract that fossil fuel and generate a lot of cash and leave it for ultimately the shareholder to decide how they then repurpose that cash that I'll distribute to them. Others are saying we're investing our cash in that transition. And so there may be a set of circumstances where they're not at their destination yet in terms of being 100% renewable, but you see a path and you see metrics that you can measure in regards to that journey, and that may be okay to have in the portfolio until the point where maybe they fall short of achieving their journey. So that's basically some of the key factors that would be discussed as part of that conversation.
Now, related to that, we have a question related to specific companies as well, which is, should the best of the worst, energy companies that are improving their disclosures, for example, be considered suitable investments in an ESG mandate? Who wants to take that one?
I'll say it depends, which may sound like a cop-out, but I think ultimately, it's a very personal decision, and it's important not to think of things in a binary way when it comes to ESG or when it comes to thinking about almost any kind of investment. But I'll leave it at that and invite Chris into the conversation.
Yeah, I guess it's important to denote that what we see today in an enterprise may look very different even a decade from now, just given macro industry shifts. And we've seen this across multiple industries over time. And I think as as fiduciaries, it's our job to identify both the magnitude of change and then try to do our best to invest on the right side of that change. And coming from Houston, fossil fuels are a topic of great discussion. My personal view is, I think we probably all agree that fossil fuels aren't going away tomorrow. But I think it's really important to note how massive the shift is in the efficiency of technology that's allowing other types of energy to come into the market. We call them renewables. I think we should be thinking more broadly about thinking across energy broadly rather than specifying. A lot of people silo fossil fuels versus renewables. It's energy at the end of the day, and Stuart touched on storage a few moments ago. So I think we need to take a look at what companies are taking steps to actually reflect the reality of macro shifts in multiple industries, which often are hugely pivotal in terms of the future direction of those enterprises.
Thanks, Chris. Sticking to company specificity again, we have a question which I will just read out verbatim. Really glad you're addressing this. I've been living off-grid more or less self-reliantly for the last 38 years. Back then, we could only dream of investment opportunities that reflect our values. Thanks. Now I know companies like Shell are making things like solar panels, but they're still too entrenched in fossil fuels. Will these RS funds exclude these companies who only talk and not walk? And that's a hard question.
Look, Robertson Stephens is based on substance, and we're substantive in our commitment to our key values of being a fiduciary, of the importance of integrating a financial plan into an investment portfolio construction, and in regards to how we source, diligence, and recommend with conviction our investment ideas. And as it relates specifically to this company, there's no specific buy, sell, or hold recommendation, as I'm sure our compliance officer would be very happy to hear me say. But what I would say is, you need to sort of ask yourself, do you only want to invest in companies which are currently and strictly in adherence with a very specific set of rules? And Chris did a nice job of sort of outlining, what some of those UN principles are around sustainability. Or if we can measure the data, we can then manage the portfolio to see if certain companies are actually walking the walk and are committed to the transition that they say they're going to do. And we can hold them accountable to that. And in the event that maybe they fall short of those goals, then they could be divested from the portfolio, or an asset manager who's focusing on that company, for example. So I think, again, it really just depends on what's important to you, and then we can have the portfolio reflect that.
Couple thoughts there too, just to add on to that with that specific example. We're not alone here. The largest pools of capital on the planet are actually holding these companies accountable as well. The Norwegian Sovereign Wealth Fund is one of those, some of the largest pension funds in the world as well. Specific to the example of the company you mentioned, which is has a large presence where I come from in Houston, it's really interesting to see how many traditionally trained professionals from those organizations are actually leaving traditional energy enterprising and starting new companies predicated on a lot of the principles we're talking about here. So much as we've seen in asset management firms of teams that are leading with ESG, people peeling out of larger organizations to hone their skill set, for example, around water or clean tech or energy. We're seeing the same thing in Houston and elsewhere in traditional energy, where people are leaving those institutions and actually basing their traditional knowledge and skill set, which is highly professional and intense, around the new world in so many issues that we're talking about here. So some very interesting developments there as well.
Thank you, Chris. Just sticking with you, give us an example of a company that's made good progress in ESG and why.
Now, will compliance let us speak company specific?
You know what? Why don't we come back to the client? I've noted down which client asked. So,
that's great. Happy to do that. Happy to do that one-on-one, but I'm not sure we should do that on a public forum.
Yep. Let's move back to portfolio construction, which is where we have a couple of questions, and I'll group them. We'll ask them one after the other. But first one is, what metrics of success do you set for the various advisors when you incorporate into the investment process? What might compel you to reduce allocation or sever a relationship? Stuart, take you for that one.
You mean reduce allocation to an asset manager?
Yes.
Okay,
Yes.
got it. Okay, so
This is around advisors, not companies anymore.
right. So
I mean, or yeah, well,
asset managers, right? Yeah. So we construct portfolios with third-party asset managers. As people know, our commitment to being a fiduciary and walking that walk is not generating any of our own RS investment products, but going out and finding what we believe are best-in-class managers for each of the key asset classes. And again, it's a combination of active and passive. But what we measure, and it's dynamic, and we monitor these kinds of things regularly, and we have deep dive quarterly calls with all of our managers as well as part of our monitoring process. But what we're looking for, first and foremost, relates to just integrity. Are they doing what they said they would do? And then we measure that in regards to certainly performance. And many times people would sort of flag as a yellow light underperformance. We would flag as a yellow light performance that maybe go over and beyond what we would expect, because then that could suggest maybe that they're drifting into certain kinds of investments or concentrating the portfolio in certain ways that really wasn't part of the original mandate. We also look for turnover, because we recognize that our investors are tax sensitive. And to the extent that a portfolio is being turned over more frequently than what we originally had thought and expected, that in itself could be an issue, absent certain macro conditions which would justify it. We're thinking obviously about the team and the culture, because in an asset management firm, the most important asset that they have back before COVID was its people who would go up and down in the elevator every day. And so we need to understand what's going on with the team, the culture, if there are any material new hires or departures in regards to the team. And again, if it is going to be an ESG focused manager, we would really dig into the kinds of issues that Chris was referencing earlier in terms of greenwashing, and seeing whether or not it's something that they're saying but not actually doing, in the spirit of them just wanting to gather assets. And that's also another key metric to think about, which is, are there major flows in or out of that asset manager? And if the answer is yes, of course, we live in a culture of why, and we ask why a lot.
Thank you, Stuart. Last question, I think, from the audience, which is this morning, Mark Carney announced, alongside Secretary Kerry, now President Biden's climate envoy, the Glasgow Financial Alliance for Net Zero, with 43 banks from around the world, with assets of $28.5 trillion, all committing to align operational emissions from their lending and investment portfolios with pathways to net zero by 2050 or sooner, with a 2030 target focused on priority sectors where banks can have a most significant impact with their portfolios. Are you able to offer clients investment portfolios aligned with those net zero goals? And can you give a sense of what that would look like? Can you provide a fossil fuel free portfolio?
Yeah, so again, I would reference the page that we used earlier in our conversation today, which showed a spectrum of being able to employ direct indexing and exclusion types of methodologies to focus on the things that matter most to the clients. And direct indexing is a very efficient way in order to tease out within very specific industries, and then subsectors within industries, the kinds of business activities that may be in conflict with a client or a family's set of values. And so in terms of that, we can absolutely, focus on things that maybe are cause an allergy. In regards to constructing portfolios specific to this, I haven't seen the headline, I haven't seen what is going on there, but we could certainly construct, if you would, an index of banks that specifically have signed on and committed to those kinds of goals and objectives, and that in itself could be part of a portfolio. The exciting news about what's happening in the world of investing in ESG today is that there's a lot of movement, motion, and technology that can come together to really try and tailor a solution to clients that have specific ideas around what their values are. And we endeavor to work with our clients in a way that is responsive to those needs.
Thanks, Stuart. We have one more question. I'll give it also to you, Stuart, since it's on a topic you've spoken about a lot, which is China. Can you discuss the ESG and this climate summit in the context of US and China?
Yeah, so I think it's incredibly interesting regards to China and the US coming together here. There's obviously been there was a bit of a footfall with that meeting in Alaska. That didn't go too well, but China continues to build coal-fired power plants, right? But it's also becoming a global leader in renewables like solar power and electric vehicles, like I mentioned before. Beijing probably sees this summit that they're participating in this week as a win-win opportunity. It's helping to get more countries on board with climate goals, which the US also wants, while also creating more global demand for renewables technology that China is keen to sell. They really are investing in renewables and technologies, and they see themselves as a leader in being able to export that technology around the world. So we're moving away from a traditional trade war to a technology war between the US and China. And I think renewables and ESG topics are at the forefront of that and important to think about. I would broaden the lens for a second and just sort of say that people should be very mindful of the green wave in Europe. It's no longer an extreme and it's no longer a fad. And there are a number of key elections, specifically in Germany and France, that are taking place this year where it seems the Green Party candidate is more likely than not to be extraordinarily competitive, and there appears to be potentially a woman who will be the heir apparent to Merkel in Germany, who's the Green Party nominee. So just be very aware of that as well.
Chris, Stuart, thank you again for your insights, and a very big thank you to all our clients for your business and for attending today's webinar. If you have any questions or interested in more information about ESG, please contact your wealth manager. As a reminder, this webinar will be posted at the end of April on our website, rscapital.com. Thank you again, and I look forward to seeing you all at our next webinar very soon. Thank you.
Thank you.